American Airlines just dropped Q1 2026 earnings this morning, and on the surface, it looks like a win. Revenue came in at $13.9 billion, up nearly 11% year over year. Adjusted EPS was negative 40 cents, beating the street's negative 45-cent estimate.
And yet, the stock is sitting at $11.78, market cap of $7.78 billion. That's less than the interest American will pay on its debt over the next 4 years.
That's the setup. A beat on revenue, a beat on EPS, and a stock that trades like it's in distress. The bulls call it the most mispriced airline in the S&P. The bears call it a zombie balance sheet waiting for the next fuel spike.
$33.6 billion in net debt, 8 times trailing EBITDA, negative book equity of $4 billion. Those are not numbers that show up on Delta's balance sheet or United's balance sheet.
And yet, sitting underneath that leverage is what might be the single best loyalty program in commercial aviation. AAdvantage generates over $6 billion a year in high-margin credit card economics. By itself, that asset could be worth more than the entire equity market cap of the airline.
Which is the central puzzle. You have a crown jewel loyalty business bolted to an airline with the worst leverage ratio in the big three. Investors have to decide which half of that sentence they're buying.
So the question today, is this the trade of 2026 at 0.14 times sales, or is this a value trap that stays a value trap?
Let's work it out. 13 sections, full teardown.
Let's ground this in what American Airlines actually is. Because when people say AAL, they are not just talking about planes.
American Airlines traces its roots to 1930, when a collection of small regional carriers consolidated into American Airways, renamed American Airlines in 1934. Fast forward through 9 decades of mergers, deregulation, and bankruptcies, and you land at the modern American Airlines Group, formed in 2013, when AMR emerged from Chapter 11 and merged with U.S. Airways.
That 2013 merger is the skeleton key to understanding the balance sheet. American came out of bankruptcy, took on U.S. Airways, and almost immediately began returning capital to shareholders via buybacks at prices we'll probably never see again. Then the pandemic arrived and the leverage ratchet locked in.
Headquarters in Fort Worth, Texas, 133,100 employees. Hubs at Dallas-Fort Worth, Charlotte, Miami, Chicago, O'Hare, Philadelphia, Phoenix, Washington, D.C., New York, JFK, and Los Angeles. That's 9 hubs, more than any other U.S. carrier.
9 hubs is a double-edged sword. It gives American the widest domestic network in the country. It also means a lot of fixed overhead and limited ability to flex capacity when demand softens.
Segment mix in Q1 2026. Domestic passenger around 8.5 billion, 61% of revenue. International passenger 4.8 billion, 35%. Cargo and other about 600 million, 4%.
And then there is AAdvantage, one of the 3 largest frequent flyer programs in the world, co-branded cards with Citi and Barclays. Over $6 billion a year in high-margin revenue that doesn't care whether jet fuel is at $70 or $90 a barrel.
That's the quiet asset, because if you benchmark AAdvantage against what United's Mileage Plus was valued at during the pandemic financings, you get a standalone implied value somewhere between $15 and $20 billion, which again is more than the current equity market cap.
Add the transatlantic joint business with British Airways and Iberia, plus the Pacific joint business with Japan Airlines, and you have a truly global revenue base. This is not a regional carrier. This is global flag-level scale sitting inside a stressed capital structure. Let's talk about the person running this. Robert D. Isom Jr. took the CEO job in March 2022. Before that, he was president and COO.
Isom joined America West Airlines back in 1997. He was there when America West merged with U.S. Airways in 2005, and he was there when U.S. Airways merged with American in 2013 to create what is still, today, the world's largest airline by fleet size.
So this is a merger guy, an operations guy. He came up through the network planning, the on-time performance metrics, the schedule design side of the business. He is not a marketing visionary, and he is not a finance-first CEO.
Which matters, because the job in front of him is fundamentally a financial turnaround. You can have the best on-time performance in the industry and still not pay down $33 billion of net debt without the revenue line cooperating.
Contrast that with Ed Bastian over at Delta. Bastian is a former CFO. He ran the numbers before he ran the airline. He's built Delta's strategy around premium cabin, international, and loyalty economics in a way that has compounded margins for a decade.
Isom's pitch is what he calls AAL 2.0. 3 pillars. Network simplification, which means exiting unprofitable routes and concentrating capacity on Dallas-Fort Worth, Charlotte, and Miami. A-Advantage monetization, which means squeezing more out of the Citi and Barclays card partnerships, and debt deleveraging, with a stated target of net below $15 billion by 2027.
$15 billion by 2027 is the number the street is watching. They are at $33.6 billion today. That implies roughly $19 billion of net debt reduction over 22 months.
Which is a lot. It requires both the asset sales and the operating cash flow to cooperate. Not impossible, but it leaves zero room for a bad summer.
Is he the right CEO for that task? I think the honest answer is that he is the right CEO for the operational side, and the street is still waiting for him to prove he can force the capital structure to match the operational story.
And he has to do it without the premium cabin depth that Delta and United have, so he's running a harder race with a heavier pack.
Now we get to valuation, and this is where the debate gets spicy. Stock at $11.78, market cap $7.78 billion.
Price to sales trailing 12 months 0.14 times. That is the headline number. For context, Delta trades at 0.41 times sales, United at 0.40 times, Southwest at 0.48 times. American is trading at roughly one-third the multiple of its closest peers.
And the forward EPS projection tells a very different story than the backward-looking numbers. The forward EPS projection for 2026 is $1 flat. For 2027, $2.16. For 2028, $2.94.
Do the math at 1178. That's 11.8 times 2026 estimate, 5.5 times 2027 estimate, 4.0 times 2028 estimate.
4 times 2028 earnings. For a company generating $56 billion in revenue with a global hub network and a $6 billion annual loyalty cash flow. That is a distress multiple attached to an arguably non-distressed business.
But the forward EPS projection is just that, a projection. It assumes summer 2026 delivers, it assumes fuel stays benign, and it assumes no labor disruption. Any one of those breaks, and the 2027 number walks backward.
Fair. Let's run the re-rating math. If AAL traded at 0.25 times sales, halfway to where Delta sits, on $56 billion of revenue, that implies an enterprise value north of $14 billion on equity alone, roughly double today's share price.
And if it traded all the way up to Dow's 0.41, you're talking a stock in the low 20s, which is also roughly where the analyst high targets cluster.
So the re-rating math is real. The question is whether the discount is permanent because of the balance sheet or whether it collapses the moment deleveraging gets credible.
My answer, the discount exists for a reason, and the market will close most of it only after 2 consecutive quarters of double-digit EBITDA margins, not before.
Which means this is a wait for the print story, not a headline beat story. Today's print, revenue $13.912 billion, up 10.9% year over year versus Q1 2025's $12.551 billion. Beat the consensus of $13.792 by $120 million.
Adjusted EPS negative 40 cents, beating the negative 45-cent estimate by a nickel. GAAP EPS negative 58 cents. Net income negative $382 million on a GAAP basis.
Operating income negative $41 million. EBITDA $527 million, a 3.8% EBITDA margin for the quarter.
And here's the seasonal footnote that every airline analyst has to caveat. Q1 is structurally the weakest quarter in airlines. Business travel is still ramping after the holidays, leisure demand is soft, and weather disruption risk is at its annual peak. Carriers make 70 to 80% of annual profit in Q2 and Q3.
So a small operating loss in Q1 is not by itself alarming. What matters is the trajectory into the summer.
Revenue quarterly progression. Q2 2024 $14.334 billion, Q3 2024 $13.647, Q4 2024 $13.660, Q1 2025 $12.551, then Q2 2025 $14.392, Q3 2025 $13.691, Q4 2025 $13.999, and Q1 2026 $13.912.
So Q1 2026 is running $1,360 million above Q1 2025. That's the 10.9% growth showing up in the numbers.
The beat on revenue by $120 million came from stronger than expected premium cabin demand and modestly better international yields. That matches what Delta said about premium earlier in the week.
And the EPS beat came partly from cost control and partly from lower fuel than some models had assumed. Not a quality of earnings red flag, but also not the kind of beat that upgrades the full year by itself.
Implied Q2 2026 guidance, based on management commentary, points to revenue around $16.4 billion and a meaningful swing back to profitability. That is the print that actually matters. July is the moment of truth.
Q1 was a checkpoint, Q2 is the exam. 12 analysts covering this name, 5 buys, 6 holds, 1 sell. Average price target $16 flat. That's 35.8% upside from $11.78.
Recent rating actions: UBS reiterated buy on April 15th, Citigroup buy on March 20th, JP Morgan overweight on January 28th, TD Cowen buy on March 9th, Wells Fargo equal weight on March 16th, Jefferies hold on March 12th, Evercore inline same day, and Goldman Sachs sell all the way back from August 2025.
Notice the pattern. The bulls are in the coverage universe, the holds are waiting for Q2 confirmation, and Goldman is the lonely bear who started getting short before the others even started paying attention.
The hold camp is essentially saying, we believe the AAL 2.0 plan can work, but we are not willing to put a buy on it until we see the summer margins print, which is a rational stance given the leverage.
Goldman's sell thesis, as best I can piece it together from their published work, centers on 3 points. 1. Leverage is too high to absorb any fuel shock. 2. Labor costs are going up, not down. 3. AAL's margin structure is permanently inferior to Delta and United.
That is a defensible view, especially because Goldman is valuing this on downside scenarios, not upside scenarios. If you run the same numbers assuming summer comes in light, you get a fair value meaningfully below today's price.
So the street view is bifurcated. The bulls see a 5 times forward earnings stock with a loyalty kicker. The bears see a highly leveraged carrier with structural margin inferiority.
And the consensus $16 target is, I'd argue, a split the difference number that assumes partial re-rating but not full re-rating.
16 is neither the bull case nor the bear case. It's the compromise case.
Which is usually where consensus lives, and usually where consensus is wrong in one direction or the other.
Let's get under the hood. Gross margin on a trailing 12-month basis is 26%, EBITDA margin 3.8%, operating margin 3.0%, net margin 0.36%.
Put those next to the peers. Delta runs 12 to 14% EBITDA margin, United runs 10 to 12%, American at 3.8% is running at roughly 1/3 of Delta and less than half of United. That is the structural gap.
And it's not a new gap. It has persisted for years. Some of it is mix. Delta and United have more premium cabin and more international long-haul exposure. Some of it is cost structure. American has had higher unit costs post the 2023 pilot contract, and some of it is the legacy of the 2013 merger integration, which took longer than anyone expected.
Balance sheet. Cash plus short-term investments $7.294 billion, short-term debt $5.248 billion, long-term debt $29.284 billion, total debt $34.532 billion, net debt $33.629 billion.
Total assets $63.738 billion, but equity is negative $4.077 billion. Negative book equity is a legacy of bankruptcy accounting, buybacks at higher prices, and pandemic losses. It's not as dramatic as it sounds, but it's also not nothing.
Current ratio 0.49. That means current liabilities are roughly double current assets. Interest coverage 1.91 times. That means EBIT covers interest expense less than twice over. In a bad year, that ratio could compress quickly.
Quarterly interest expense $397 million. Annualized, call it $1.6 billion a year just to service the debt. That is a massive claim on cash flow before any growth investment, any fleet renewal, any shareholder return.
Q1 operating cash flow was $4.223 billion, which sounds amazing until you remember that Q1 OCF is artificially inflated by advanced ticket bookings for the summer. Travelers are paying now for trips they'll take in June and July, so Q1 cash flow systematically overstates the full-year run rate.
Right? If you look at trailing free cash flow, you get 1.91 billion TTM, and the quarterly cadence tells the story. Q2 2025, 464 million. Q3 2025, negative 872. Q4 2025, negative 1.904.
Translation: the back half of the year burns cash. AAL relies on the front half advance booking boost to fund the full-year picture. That is a normal airline pattern, but it is not the kind of cash profile that pays down $19 billion of debt quickly.
So the financial health picture is inferior margins, severe leverage, seasonally distorted cash flow, and a thin interest coverage cushion. Anyone underwriting this has to believe summer margins expand meaningfully. Now the bull case, 5 catalysts. And I want to give this its strongest form because the bears get most of the airtime in this name.
Catalyst 1. AAdvantage loyalty monetization. Co-branded credit card partnerships with Citi and Barclays generate over $6 billion annually in high-margin revenue. Management targets mid-single-digit growth through 2027. Crucially, this revenue is largely immune to fuel prices and demand cycles.
This is the point bulls hammer. The loyalty cash flow is an annuity. If you apply any reasonable multiple to $6 billion of high-margin loyalty revenue, you get an implied standalone value north of $15 billion and plausibly toward 20. The equity market cap is under 8. The loyalty business alone is worth more than the entire equity.
Catalyst 2. Debt deleveraging. Net debt has already fallen from above $38 billion at the pandemic peak to $33.6 billion today. Management targets below $15 billion by 2027, implying $3 to $4 billion of annual paydown. Every billion of debt reduction saves roughly $50 million in annual interest expense.
That is a compounding flywheel. Less debt, less interest, more EBITDA drops to the bottom line, more equity value created, which in turn lowers the cost of any refinancing.
Catalyst 3. Unit revenue recovery. Total revenue per available seat mile is growing as AAL exits unprofitable routes and concentrates capacity on Dallas-Fort Worth, Charlotte, and Miami. Premium cabin and international long-haul are showing above-average RASM growth.
The network simplification story matters because airlines historically have struggled to kill unprofitable routes quickly. If ISM actually does it, unit economics improve structurally, not cyclically.
Catalyst 4. Summer 2026 demand. Q2 and Q3 are where airlines make 70 to 80% of annual profits. Advanced bookings for summer 2026 are strong. Management is guiding positive year-over-year unit revenue. Q2 2026 revenue estimate sits $16.4 billion.
And remember, Q2 2025 was 14.392, so 16.4 would be a roughly 14% year-over-year jump. That is a big number if it prints.
Catalyst 5. Valuation discount re-rating. At 0.14 times PFRS versus Delta at 0.41 and United at 0.40, AAL is at a 65% discount. Even a partial re-rating to 0.25 PS implies a stock in the $18 to $20 range.
Roll the 5 catalysts together, and the bull case sounds like this. A loyalty business worth more than the market cap, a credible deleveraging plan with $50 million per billion of interest savings, network simplification lifting unit revenue, a strong summer setup, and a valuation that prices in almost none of it.
If you believe it, the upside is 60% and plausibly a double. That is a real asymmetric payoff.
Now let's steelman the bear case. And this is the case Goldman has been making for the better part of a year.
Risk 1. Leverage is existential. Net debt of $33.6 billion at roughly 8 times trailing EBITDA is materially above Delta at around 3 times and United at around 4 times. Any revenue shortfall or cost shock accelerates the leverage spiral.
And with 5.2 billion of short-term maturities, the company is going to be in the refinancing market. The cost of refinancing depends on rates, credit spreads, and the credit perception of the airline. None of those are particularly favorable right now.
Risk 2, tariff and macro demand. 2026 tariff uncertainty weighs on corporate travel budgets and discretionary consumer spending. Business travel, which generates 40 to 50% of revenue on 20 to 30% of seats, is most exposed to corporate cost cutting. A 5% decline in business yield would wipe out most of AAL's operating income.
That's the knife edge. AAL has a thinner margin, so the same demand shock does more damage to its P&L than it does to Delta's or United's.
Risk 3, fuel cost volatility. Jet fuel is roughly 25% of total operating costs. AAL runs a minimal hedging program, unlike Delta, which hedges aggressively. A sustained move above $90 per barrel crude adds $800 million to $1 billion in annual fuel costs before any revenue offset,
which directly compresses the EBITDA needed for debt service. You can see why Goldman frames this as a levered bet on fuel prices, whether management intends it that way or not.
Risk 4, labor cost escalation. The 2023 pilot contract alone added roughly $1.8 billion in annual costs. Flight attendant and ground crew contracts are up for renegotiation in 2026 and 2027. Post-pandemic union leverage is high. This is not a cycle in which airlines get labor concessions.
So you have a leveraged balance sheet facing structurally rising labor costs at a time when revenue growth is uncertain. That is not the setup anyone would choose for a deleveraging plan.
Risk 5, structural inferiority to rivals. Delta earns 7 to 9% operating margins. United earns 5 to 7%. AAL barely cracks 3% in good quarters. Higher premium exposure, better cost structure, stronger balance sheets mean DAL and UAL consistently outperform AAL in the same demand environment, while its rivals, Delta and United, have used the post-pandemic recovery to restructure their balance sheets aggressively.
That is the most uncomfortable version of the bear argument, that this is not a temporary cyclical trough, that AAL may simply be the structurally weaker carrier in the big three, and that the discount is therefore permanent.
If the bear case is right, the stock is not cheap at $11.78. It is appropriately priced for inferior returns on capital in perpetuity.
And the bears will tell you, value traps look cheap every single day of the year, until they are still cheap 3 years later, and you have dead money. Let's lay out the peer group, because valuation in airlines is almost always a relative exercise.
Delta Airlines, PS 0.41, revenue growth plus 8.2%. Strongest margins in the industry, cleanest balance sheet, premium cabin leader.
United Airlines, PS 0.40, revenue growth plus 7.9%. Similar hub network to AAL, notably better balance sheet. United is probably the cleanest structural comp because the network overlap is real.
Southwest Airlines, PS 0.48, revenue growth plus 4.1%. Point-to-point model, ongoing turnaround, but the market still pays up for the simplicity of the business model.
Alaska Air Group, PS 0.37, revenue growth plus 5.8%. Efficient regional operator, integrating Hawaiian, executing well.
JetBlue Airways, PS 0.22, revenue growth negative 1.2%. The most troubled of the public group, real existential questions about the business model.
And American at 0.14 PS, below even JetBlue. That is the deepest discount in the U.S. airline peer group.
Which tells you the market is pricing AAL closer to the distressed end of the spectrum than to the legacy 3 peer group it belongs to operationally.
The question is whether the gap closes or widens. Bulls say it closes because deleveraging is real. Bears say it widens because the margin gap to DAL and UAL is structural.
Historical precedent. You have seen airline valuation gaps close before. Delta itself traded at a deep discount in the early 2010s and re-rated meaningfully once the market got comfortable with its margin structure. That took roughly 3 to 4 years.
And you have also seen discounts persist for long periods when the leverage never actually comes down. The warning example in the industry is any carrier where management keeps pushing the debt paydown timeline out by a year each earnings call.
For the gap to close in 2026, you need two things: Q2 EBITDA margin above 11% and visible progress on the path to 15 billion net debt. Without both, the discount stays.
So AAL's relative position is the deepest discount carrier with the most to prove. The setup is asymmetric both ways. Let's read the options market, because sometimes that tells you more about positioning than the sell-side reports.
Elevated put open interest at the $10 and $11 strikes, which is right around the 52-week low of $9.21. That reflects institutional downside hedging ahead of summer demand confirmation.
Translation: big holders are not selling the stock outright. They are buying puts to protect against a bad summer scenario. That is how you play a name when you want the upside option, but you cannot stomach the drawdown.
Call interest is concentrated at the 14 to 16 range, which is right in the analyst price target zone. Minimal sweeps above 14, notable open interest in the $10 January 2027 puts.
That January 2027 put interest is interesting. It's effectively a bet that AAL could still be trading in the high single digits going into the first quarter of 2027. Someone is planning for a multi-quarter drawdown scenario.
The structure of the option chain is basically pricing a binary. Either summer delivers and the stock migrates toward the 16 target, or summer disappoints and the stock tests the single digits.
There is no middle ground in the options market right now. Nobody is paying up for calls at 20, and nobody is aggressively hedging the $5 strike. It's a bimodal setup.
On the insider side, CEO Isam is exercising and selling shares under a standard 10b5-1 plan. That's pre-scheduled automatic selling, not a discretionary signal.
No significant open market insider purchases in the past 12 months, which is worth noting because at 5.5 times 2027 earnings, if insiders truly believe the numbers, you'd expect to see at least symbolic open market buying.
The absence of insider buying is not bearish on its own. Many public company executives simply do not buy in the open market. But it does mean you, the investor, do not have an insider tailwind here.
So the positioning picture is: institutions are hedged, the chain is pricing binary, and insiders are selling on autopilot. None of that is definitive either way, but it tells you this is a name with conviction in both directions and limited confidence in the middle. Let's wrap this up. We've covered the business, the balance sheet, the valuation, the catalysts, the risks, the peers, and the positioning.
And we should quote Isam directly. From today's earnings call, his closing remarks: "We delivered a solid first quarter with revenue growth of nearly 11% year over year and adjusted EPS that beat expectations. Our commercial initiatives are working, Advantage is performing well, and we remain committed to the debt reduction targets we have laid out. The summer travel environment looks strong."
That's a confident statement from the CEO. Not hyperbolic, not defensive, calibrated, which is what you want from an operational CEO running a deleveraging story.
The summary numbers: 5.5 times 2027 estimated earnings, 0.14 times sales versus Delta at 0.41, a 65% discount. Debt paydown roadmap to 15 billion by 2027. A loyalty business standalone worth more than the current equity market cap.
The single watch item is Q2 EBITDA margin. If Q2 clears 11%, the deleveraging path is credible, the re-rating starts, and $5 higher is in play. If Q2 comes in below 9%, the 15 billion net debt target is effectively off the table, and the street will say so.
That is a July 2026 catalyst, roughly 80 days from today.
So what is this, a trade, a position, or a pass?
My read: it is not a pass. 0.14 times sales for a global legacy carrier with a $6 billion loyalty annuity is too cheap to dismiss, but it is also not a core position for anyone who cannot stomach a potential drawdown to single digits if summer disappoints.
I'd frame it as an asymmetric trade with a defined catalyst. You size it small, you sit through Q2. If the margins print above 11%, you add. If they print below 9%, you are out. No hesitation.
Clear-eyed verdict: high risk, high reward, event-driven, not a widow and orphan stock, not a permanent hold, a specific trade on a specific summer with a specific exit trigger.
Summer 2026 is the referee. Everything else is commentary.
This episode is for informational and entertainment purposes only and does not constitute financial advice. Always conduct your own research or consult a licensed financial advisor before making any investment decisions. The views expressed are those of the hosts and do not represent the positions of any affiliated entity. Thank you for listening.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.